Welcome to this Click Explains Finance video. This week I'm going to take a look at the topsy-turvy upside down world of the negative bond yield. Sounds a bit dramatic, sounds a bit technical. Actually it's not too bad to understand. It does matter and we need to take a look at why it matters for investors and what sort of reaction they should have to it. So first of all, how does this happen? Well, since the financial crisis around 2007-2008, central banks have tried to stimulate the economy, and as a rule of thumb, as part of that, the overall return on their IOUs, that's the yield on state-backed debt, if you like, issued by the US and the UK governments, has shrunk. And as that's happened, it's rippled out. The effect has rippled out across the rest of the market because the yield on safe government-backed IOUs tends to be the lowest, and as you get into riskier parts of the market, longer dated issues, you tend to find that yields rise. But this compression of the yield has sort of shrunk yields across the board. Demand's actually turned the yields negative on quite a few bonds, and we'll see how many in just a moment. So we need to ask the question, who is buying and why? And also, if people are thinking, crikey, what is this thing? A negative yield. But it turns the word on its head in essence, because normally, if you lend somebody money, you would expect them to pay you some sort of return. In the world of negative yields, you're lending them money by buying IOUs, and in effect, you could see it this way, you're paying them for that privilege. So it is kind of upside down compared to what people are normally used to. Right, so how common are negative yields? Is this a problem confined to one part of the market? No, it definitely isn't anymore. So a negative yield is a yield below zero. More about how that happens coming up in just a moment. The outstanding global debt to which this applies, Bloomberg Barclays data, is around 17 trillion US dollars. And if you're thinking that's quite an impressive sounding number, what does it mean? Well, the answer is that's about 30% of total global bond issuance carries one of these negative yields. So it's no longer something that's confined to some arcane part of the market. It's rippled across a massive section of it. So basic nuts and bolts, and apologies for those people who already know this stuff. How do you get a negative yield? What does it look like? So in essence, the mechanics would be this. Let's say, very simple example, I'm going to simplify all the maths just to make the point. Let's say a 5-year bond is issued with a coupon rate of 2%. Now that's a positive coupon rate, so that's the interest it pays. But people thinking, well, that's not a negative yield, that sounds like a positive number, are forgetting that with bonds, there's a difference between usually the issue price and the redemption price, the price it's brought back at. And that brings another factor into play called a capital gain or a loss. Put that into the equation with that, and you get the overall yield. And that can be positive or negative. Now, what do I mean by that? Let's say at auction, this thing sells for £120 per 100 nominal. Now, 100 nominals just a quantity. It's a bit like saying a kilo of carrots, if you like. The price is what the market sets. So lots of people want this thing, so they're paying above its nominal value to get hold of it. But when it's finally redeemed in 5 years' time by the issuer, you'll only get £100 back. So to translate that, you're paying 120 now to get £100 back, and you're getting a 2% coupon while you wait. And that means, very crudely, simplifying the maths, as a holder, as somebody who buys one of these things, you're getting £2 a year, broadly speaking, as coupon, but you're losing roughly 4 every year that you hold it, because the value is going down from 120 to 100 over 5 years. So very, very crudely, ignoring time value of money, that's £4 a year. So in overall terms, every year, you're actually losing £2, or your yield has gone negative 2%. Very simplified numbers there, slight shortcut taken on the maths, but you get the idea. That's how you can have a negative yield. Now, what's the cause? What's going on here? And basically what I've done is say, well, central banks have been trying to stimulate the economy since the financial crisis, all right? And that has had the effect, quantitative easing and so on, of dragging down yields, because it involves a mixture of lower interest rates and money printing, as it's loosely called. And a flight to safety has basically meant lots of people have gone, well, the yields are falling on these things, but I still want them. So with bonds that have got a fixed coupon, as you push the price up, that's people buying it, the yield comes down. It can be actually pushed, as I just demonstrated, negative. So basically demand for these things, flight for safety money, trying to find somewhere to sit, if you like, during turbulent times, that has pushed demand up and pushed yields down. So a number of factors working in tandem. So who would buy these things? You might think, why on earth would you buy something with a negative yield? Remember, that implies that effectively you are lending someone else your money, okay, and basically paying them to borrow it. Weird. So who are these people? I've divided them into two camps. First of all, strategic buyers. People looking at it and saying, not a problem, we can work with this. So an investor expects to make a capital gain before maturity. Because don't forget, it is possible to make a capital gain. How does that work? Basically, you sell the bond on for more than you paid for it, and that will change the overall yield. Someone expecting to make an even worse deal on deposits. So Eurozone deposit levels, for example, the rates on those deposits be negative for a while. So someone might be thinking, well, I'm looking for a safe place to put my money. A standard sort of bank deposit would be one option. I can buy an IOU, which is virtually as safe, if you like, some would say slightly safer in some circumstances, and it will give me a better return, albeit still a rubbish one, than a pure deposit. So there are people looking at it that way, because they need somewhere safe for their money. And then overseas buyers who make a bit of a gain from matching currency hedges. In the last issue of Confidant, you can read a bit more about that, Mattis Malik's article on negative bond yields. He explains in a bit more detail how that works. There are overseas buyers who make in the round a gain from a mixture of buying these bonds with negative yields and hedging out the currency risk. Then you've got forced buyers. So less strategic, more like, I don't really have any choice. So pension funds trying to match liabilities. There's only so many ways a pension fund with a known future liability, commitments to pay people in the future in defined benefit schemes, final salary schemes, there's only so many ways they can match that. Bonds are one of the biggies. Overseas banks trying to manage their foreign exchange reserves may have little option but to hold bonds. They're not fabulously amazed by the negative yields, that's not great news, but they still need to hold them. And then you've got banks needing to meet liquidity requirements and or use them as backing for what are called money market transactions. And those are what I call sort of slightly forced buyers. There are circumstances in the financial markets where certain people basically haven't got much choice about what they hold, and negative yielding bonds could be in the selection. For other investors, let's step back, because you're thinking, well, I'm none of those, I'm just a standard equity investor, for example. What does all this mean? Well, basically, bond yields do set the benchmark for other assets. As a rule of thumb, people tend to look at government IOUs as really low risk, almost risk-free, and they tend to say, what's the return on that? Then as we go into more risky and risky assets, the return gets bigger and bigger and bigger. So what I'm saying is, if you bring down the yield on the benchmark asset, you bring down the yield on everything else. And that can cause people to think, crikey, why am I investing at all? Shall I run for cash? No, because the whole point is, as long as you're realistic about the absolute rate of return that you expect to make in this negative yield environment, if everything's been brought down, not a problem. It's a bit like people who are moving house. They say, well, my house has gone down in value. Yeah, but if the one you're buying has also gone down in value, not so much of a problem. So worry less about the absolute return and more about the relative return and whether you're beating inflation or not. That's what matters. People tend to lose sight of the fact that it's the return, taking inflation into account, that matters more than just the headline rate on whatever asset it is you're looking at. So relative returns are important when you're comparing, say, shares to bonds. Okay, relative returns right now, not 20 years ago, let's say, and the extent to which you're beating inflation. Keep your eye on those two things and don't worry so much about what I call the headline yield. To find out more, you can ping me at the usual place. And if you're thinking, I'd like to see a few more bonds videos, that was a bit hairy, then go to killick.com/learn. There's some tabs down this side and you want bonds.